Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Wednesday, November 12th, 2025, and we're diving into some fresh data from yesterday.
That's right, Ethan. We've sifted through a significant number of social media discussions yesterday, flagging quite a few different stocks, and I'd say the overall market sentiment we're seeing is a real mixed bag today. A lot of excitement, but also a healthy dose of skepticism, which is exactly what we like to see.
Absolutely, Brooke. Let's dig in and see what's caught our eye for potential multibagger status. All right, first up, let's talk about Micron Technology, Inc., MU. We've seen some past success stories from users making fat MU gains, and the company's revenue growth is looking strong at 46%. It was even rated a buy by us back in early October.
Well, Ethan, while that past performance sounds good, our AI-generated insights are now suggesting a stay away. The current price-to-earnings ratio is a high 31.77, implying a lot of future growth is already priced in. More critically, the debt-to-equity ratio is an alarming 28.34, which is a substantial financial risk. And recent news even shows MU sinking as market gains. That tells me there might be some specific headwinds.
Okay, Brooke, point taken on the current indicators. For MU, given the current valuation and financial leverage, our AI analysis concludes it's a stay away right now.
Next, let's turn our attention to advanced micro devices, AMD. Ethan, you've been quite bullish on their AI potential, but I'm seeing some red flags.
I certainly am, Brooke. While some users are wary of an AI bubble, the latest news for AMD is incredibly strong. We're talking 35% annual sales growth and projections for their data center revenue to soar by 60% over the next few years. CEO Lisa Su sees a $1 trillion AI market, and AMD plans a $20 EPS target compared to current 1.9. This is exactly what we look for in growth potential. AMD has been rated stay away multiple times in the past, but the new growth catalysts are huge.
I appreciate the optimism, Ethan, but the PE ratio is still a staggering 125.01. That's a lot of future success baked in. Also, their net profit margin is a relatively low 10.32%, especially compared to competitors. And let's not forget the debt to equity at 6.36. While the news is promising for future KPIs, the current valuation means there's very little room for error.
Yeah, that's a fair challenge. The potential is massive, but the current price reflects a high level of expectation. So for AMD, we're classifying it as a cautious buy. The long-term growth story is compelling, but definitely approach with eyes wide open. Okay, let's look at Nebius Group, NBIS. The talk around their $3 billion Meta AI deal is massive, with users expressing strong bullish sentiment. We even rated a buy earlier this month.
Ethan, I have to step in here. Despite that exciting Meta deal, the company's financials present a serious challenge. The PE ratio is an astronomical 132.75, with a net profit margin of less than 1% and a negative operating margin. Plus, their debt to equity is incredibly high at 32.427. While the deal has huge future potential, it's already priced in, and the current profitability just isn't there to support it. Our AI analysis concludes it's a stay away, despite the user optimism.
Wow, that's a tough pill to swallow for such a big deal. For NBIS, our AI-generated analysis suggests stay away. Now for iRan Limited. iRan, this one looks promising. We saw one user turn $1,640 into $20,300 with options, and they call it a true growth stock. Plus, there's that big Microsoft AI deal, with one analyst predicting it could soar nearly 500% by 2028. This sounds like a multi-bagger in the making. It was stay away as recently last week, but these catalysts are significant.
Ethan, I agree. The news is compelling here. While the beta is a high 4.22, indicating volatility, the return on equity is a healthy 26.12. And yes, the Microsoft AI partnership is a clear, strong catalyst for future revenue and earnings, potentially justifying its PE of 32.97. This actually looks like a rare instance where the positive news aligns to potentially improve those KPIs.
Fantastic. For iRan, this is a clear buy. Moving on, let's talk about First Commonwealth Financial Corporation, FCF, though the analysis here centers around Rent the Runway. The main post painted a bullish picture, but the community sentiment leans skeptical.
Yeah, the post highlighted potential 4 to 10x upside with positive free cash flow projections by 2026 thanks to AI efficiency. That's the kind of turnaround story I like. But Ethan, the reality is the current free cash flow is NA, meaning it's not positive, and the stock is near its 52-week low. One user even called it a dying retailer. Without current positive cash flow, those projections are purely speculative. We simply can't ignore the lack of fundamental cash generation.
Understood, Brooke. For FCF, we're classifying it as a stay away.
Next up is Core Weaving, ICRW. The company's Q4 guidance was trimmed due to data center delays, and frankly, the financials are concerning.
I know, but demand for their services is still high. Sometimes delays are just growing pains for a company in a booming sector like AI.
Growing pains don't excuse a negative net profit margin of negative 28.8, an EPS of negative 1.72, and an astronomical debt-to-equity ratio of 381.14. Plus, a negative price-to-book ratio is a major red flag, indicating liabilities exceed assets. Users are calling it scammy and burning money, and the KPIs back them up. This company is facing serious financial risk.
You've laid out a pretty compelling case there, Brooke. For CRWV, it's a stay away.
How about Strategy Inc., MSTR? Users are desperate for a rally, with comments like "I'm cooked" and frustration over it losing its Bitcoin premium.
Well, Michael Saylor is still buying Bitcoin, even if it's with preferred equity now, showing continued conviction in their strategy. They were a speculative gamble a few weeks ago, but the sentiment is now more dire.
Desperation isn't an investment strategy, Ethan. The stock is near its 52-week low, down 40% in 6 months. The debt-to-equity ratio is a high 14.147, and a beta of 3.374 means extreme volatility. It's underperforming Bitcoin itself, which removes a key thesis for holding it. The news highlights concerns over the quality of Strategy's earnings.
Okay, it sounds like the leverage strategy isn't paying off right now. For MSTR, that's a definite stay away.
Next up is New Forest Energy, NFE. There's a bullish user post about a turnaround, but the news is telling a very different story.
That post talked about a great CEO, massive deals like the $4 billion Puerto Rico deal, and 43% revenue growth expected. It was a speculative gamble just yesterday.
Ethan, this company is actively considering UK debt restructuring to avoid bankruptcy. Their debt-to-equity ratio is an utterly unsustainable 675.164. All profitability metrics, net profit margin, EPS, revenue growth are negative. The stock is at its 52-week low, and that 30% dividend yield is an unsustainable red flag. This isn't a turnaround story yet. It's a fight for survival.
Wow, avoiding bankruptcy is a pretty big hurdle for growth. For NFE, it's a clear stay away. Let's switch gears to Tesla, TSLA. Elon Musk's talking about mass production of AI-5 chips by 2027, with AI-6 in 2028. That's massive for their FSD and Dojo platforms, and the stock recently soared on AI predictions. We've often classified it as a speculative gamble.
Ethan, this is a prime example of future promises priced in today. The PE ratio is an astronomical 303.18. Current revenue growth is only 11.6%, which simply doesn't justify that kind of valuation. Plus, its beta is 1.872, meaning it's highly volatile. The AI chips are years away from impacting financials, and the current price is already banking on flawless execution of that distant future.
Well, they're playing the long game with AI, but the valuation is certainly elevated. For TSLA, we're classifying it as a stay away for now. How about Rivian Automotive, RIVN? The charts look like a breakout commenced, and we've seen strong Q3 results, with the stock climbing to new 52-week highs. Some users are betting on $20 this week. This has never been on our radar before.
Ethan, I'm glad to see some positive movement, but fundamentally, Rivian is deeply unprofitable. Their net profit margin is negative 61.3%, and EPS is negative 3.10. And get this, a debt-to-equity ratio of 100.222. That's a mountain of debt for a company bleeding cash. While the chart might look pretty, the underlying financials scream risk.
Okay, Brooke, you've certainly highlighted the financial tightrope they're walking. For RIVN, despite the recent momentum, we're calling it a stay away. Next, NVIDIA. Some users are inversing SoftBank's sale, predicting NVIDIA to X5 minimum due to their massive moat in AI chips. The company itself is projecting over $500 billion in GPU sales over the next 5 quarters, with 5x unit growth. We've seen it as a buy multiple times in the past.
Ethan, while the future projections are indeed mind-boggling, we have to look at the present. The PE ratio is 54.87, and the price to book is an incredibly high 46.96. That's a huge premium already baked into the stock price. The news also reports SoftBank's exit and U.S. chip restrictions in China, which are legitimate headwinds. While their net profit margin is excellent, the market is already pricing in perfection, leaving little upside for new money at these levels, especially with a beta of 2.269.
That's a strong counterargument, Brooke. The projections are immense, but the current valuation is a significant hurdle. For NVIDIA, our AI analysis suggests stay away. Finally, let's discuss Applied Digital Corporation, APLD. The stock recently plummeted, and it seems our AI analysis is still highly bearish. It was a buy for us last month.
Well, the original post tried to clarify that delays weren't APLD's fault, and they did have a 300% run previously. They're planning a $2.35 billion offering for data center construction, showing ambition.
Ambition funded by more debt, Ethan. Their debt-to-equity ratio is already 63.196, and they have negative net profit margins, EPS, and operating margins. Users are calling these companies scammy F and burning money for a reason. The high beta of 7.061 shows extreme volatility, and being unprofitable with that much debt is a recipe for disaster. Their largest client, CRVW, just had terrible guidance, directly impacting APLD's future prospects. That's a tough reevaluation. For APLD, our AI analysis indicates stay away. All right, that was a whirlwind, Brooke. A lot of potential, but a lot of caution today. Let's recap for our listeners.
Investigate as buy. IREN Limited. Investigate as cautious buy. Advanced Micro Devices, AMD. Investigate as speculative gamble. Nebius Group, NBIS.
And that wraps up another episode of The Daily Hunt for Multi-Baggers.
As always, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thank you for joining us on The Daily Hunt, and we'll catch you tomorrow.